All right, so you've definitely heard about these incredible AI models, right? Things like ChatGPT that can write poetry, spit out code, basically have a full-on conversation. But what happens when you take that same brain, that same technology, and aim it at something as wild and chaotic as the financial markets? Yeah, that is the literal billion-dollar question we're diving into today. Can the AI that's amazing at writing poems also predict stock prices? I mean, it sounds like something out of a sci-fi movie, but believe it or not, researchers are taking this incredibly seriously. All right, let's get right into it. We're going to break down a really fascinating research paper that puts this whole idea to the test. It's all about how the transformer model, yep, that's the T in ChatGPT, is being retooled for the super high-stakes world of finance. But first, you got to understand why this is so hard in the first place. See, forecasting isn't just about guessing what happens tomorrow. The real challenge, the thing that trips everyone up in finance, is predicting multiple steps ahead. And that is just a brutal, notoriously difficult problem. So, traditionally, people have tried two main approaches. The first is called iterated forecasting. You predict one step, then you use that guess to predict the next one, and on and on. You can probably see the problem, right? Any tiny error at the start just gets bigger and bigger and bigger. It's like a snowball of mistakes rolling downhill. The other method, direct forecasting, tries to predict all the future steps at once. That avoids the snowballing error, sure, but it totally misses how those future steps are all connected and influence each other. So yeah, both methods are kind of broken. So there's a much better way to frame this. Think of it like a translation problem. You're trying to translate a sequence of past market data into a sequence of future market data. And that's exactly where something called sequence-to-sequence, or seek-to-seek, models come into play. They're built for precisely this job, taking one sequence and turning it into another. And this is what brings us to the main event, the transformer model. Its secret sauce is a revolutionary idea called the attention mechanism. And trust me, it's a complete game changer from how older AIs used to process information. Now, the paper uses this brilliant analogy that I just love. When you look at a picture like this, your brain doesn't scan it like a computer, right? Pixel by pixel, left to right? No way. You instantly focus on what matters, the animals. The background, the trees, it all just kind of fades away. Well, that is exactly what the attention mechanism lets an AI do with a mountain of data. And this is so crucial, because just like trying to understand a sentence, context is everything in finance. Think about it. A piece of market data from 6 months ago could be totally useless, or it could be the one critical clue to what's happening right now. Attention is what helps the model tell the difference. So how in the world does it work? Well, the easiest way to think about it is like a super smart search engine. For any single data point, the model creates a query. That's basically it asking a question, like, hey, what other data points in history are most relevant to you? Then it looks at all the keys, which are kind of like keywords or tags on all the other data, to find the best matches. And once it finds those matches, it pulls their values, the actual juicy information, to build its prediction. Okay, so here's the absolute key. Instead of plotting through data one step at a time, like older models, self-attention lets the model look at the entire historical sequence all at once. It can instantly weigh the influence of every single data point on every other data point. This means it can find those hidden connections, those long-range patterns that older models would have completely missed. All right, so that's the theory, and it sounds pretty amazing, but the real question is, does it actually work when there's real money on the line? Let's find out. The paper put this to the test in a couple of case studies. They tested it on two classic Wall Street problems. First, trying to build a trend-following strategy, and second, trying to optimize a portfolio over a bunch of different time periods. Now, for that first case study, they kept things pretty simple. They weren't asking the AI to predict the exact stock price, down to the penny. Nope. They just wanted a simple thumbs up or thumbs down. Is this asset's return going to be positive or negative next week? That's it. And you know what? The results were pretty impressive. The transformer-based model, which they call the encoder model, hit a Sharpe ratio of 0.52. Now, if you're not a finance nerd, all you need to know about the Sharpe ratio is that higher is better. It's a measure of your return versus your risk. And as you can see, 0.52 beat the benchmark, and it also beat other more traditional machine learning models. But they didn't stop there. I mean, one good model is great, but any smart investor knows the real magic is in diversification. So the researchers asked a really important question. What happens if we don't just rely on one AI, but combine the predictions from a whole team of different models? And this chart just shows you the power of that thinking. We're looking at maximum drawdown here, which is basically an investor's worst nightmare. It's the biggest single loss you would have taken from a high point to a low point. And by combining the models, they absolutely crushed it, slashing that potential loss from over 13% all the way down to less than 9%. That is a huge deal.
So awesome. Problem solved, right? We just let the AI print money? Well, not so fast. And this is where the paper gets really interesting and delivers its most important real-world takeaway. See, using AI in finance is just fundamentally harder than in other fields, and it's for a few key reasons. First, you've got a terrible signal-to-noise ratio. It's just really, really hard to find the actual patterns in all the random chaos of the market. Second, the rules of the game are always changing. A strategy that works in a bull market could get absolutely wrecked in a bear market. And finally, think about it. AI for images has billions of cat photos to learn from. In finance, there's actually not that much high-quality data to train these massive models on.
And all of this leads to the paper's central point. The solution is not to try and build one giant, super complex God model that can predict everything. Why? Because that huge model is way more likely to just get confused and memorize all the random noise from the past instead of finding a true, repeatable signal for the future. Instead, the much smarter approach is to build an ensemble of simpler models. You can think of it like putting together a committee of experts. Each individual model, or weak learner, is simpler and less likely to get fooled by the noise. But when you combine all of their different perspectives, you get a forecast that's way more robust and reliable. It's literally diversification, but for your AI models. And the proof is right here in the numbers. That combined diversified strategy we talked about and ended up with a final Sharps ratio of 0.61. That didn't just beat the benchmark, it beat every single one of the individual models. In the end, balance and diversification, that's what won the day. So this all leaves us with a really fascinating question for the future, doesn't it? These AI tools are obviously getting incredibly powerful, but at the same time, this research shows just how noisy and chaotic the market really is. So as AI gets smarter, does the human investor become obsolete? Or does our job become even more important? To be the ones who build these AI teams, who manage them, and who provide the common sense to navigate all that noise. Definitely something to think about.